Firstly, I'd like to take a moment to acknowledge the traditional owners and their custodianship of the lands on which we meet today. And I pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to country. We recognize their valuable contributions to Australian and global society. I'd like to introduce our speaker, Tim. Thank you very much for being here with us today. Tim is a professor of economics at Purdue University, where he was appointed Granite Rising Star Associate Professor in 2018. And many of you probably know him as a member of the first round of the LCC when he was here at Uni Melbourne, where he still has an honorary appointment. And Tom is also an associate of the NBER and Economics of Aging and Health program. Tim really does a number of different research areas. He has done a lot of studies on determinants of health, as well as papers around illicit drug use and violence and risky behaviors. Besides that, one of Tim's areas of interest is social insurance, where he's worked on the effects of disability insurance on employment and earnings and survival recently. And today he's going to tell us about geographic variation in disability. Thank you very much, Tim, and over to you.
Thanks, Barbara. So I'd like to start by acknowledging the traditional owners and their custodians of the lands on which we meet today, and pay my respects to their ancestors and their descendants. Just a little bit of background about me. I'm originally from Australia. I've bounced back and forth. This topic today is on using kind of US data and focused on a US program, but I have also sort of started to do some work using Australian administrative data and looking at different sort of policy issues there. So very happy to talk to you about the topic today, but also if you ever have any interest in anything else, feel free to reach out. Okay, so what I'm going to do, I'm going to share my screen. This paper can be presented in a way that isn't very accessible to a broad audience, and so I've gone against my natural instincts, and what I'm going to try and do is present just a lot of sort of details about geographic variation in disability insurance in the United States, and I think there's kind of parallels here to Australia and other countries, and then I've got sort of a set of slides there. Then, depending on time, we can kind of dig into the modelling component. So this is a collaboration with two macroeconomists who are Amanda Michaud and David Wixer. They're both based in the US, and so one of the joys of getting a bit further along in my career and having more freedom about sort of which topics to choose has been to sort of take on a topic like this. I used to say to people when at the early stages of this project, this will either be the best project or the worst project of my career, given the challenges in sort of talking across macro and micro. I've found it a very kind of interesting project, and I hope you do too. So let me just kind of give you the big picture of the some big picture ideas of why we're interested in this. And so the program that we're interested in, and this is kind of true of social insurance programs in general, they generally insure that individuals or households. And so these households or individuals have to meet certain criteria in order to be able to claim from a program. But it's typically not the case that that where someone lives affects sort of how they experience the program. And for a lot of these programs, we're talking about national programs, but this is also true within a state. So whenever a state has a particular benefit or social insurance program, the rules tend to be applied irrespective of the exact location where someone lives. Despite that sort of uniformity, we see that there's very large geographic differences in the take up of different programs. And so I'm going to give you some statistics around that today. There would be some in the audience who would have a better sense of what's going on for things like New Start and disability support pension. But I took a quick look, and there is, unsurprisingly, if you look at urban versus, or major cities versus other urban areas versus kind of rural and regional areas of Australia, there's kind of enormous differences in take up of these programs. And to focus on the second bullet of this slide, and then the sub bullet, where that's interesting and where that's something of a focus in this paper is once you start to look at the dollars involved in these programs, then we're talking about sort of huge amounts of money. And when there's all this effort across different governments to try and have place-based policies, so a policy that will have economic zone that will kind of encourage an area that has been hit hard by a drought or sort of the shutting down of the timber industry, these sort of things. But we're talking from when it comes to these social insurance programs, really large amounts of money. And just to kind of give you a sense of the scale we're talking about here, in counties, and I'll talk a bit about what counties represent, some counties in the United States, as much as 20% of their labor income is sort of work type income is coming through disability benefits, and that's just far larger than anything that's getting committed to them in terms of economic development policies. It's also the case, to sort of go to the final bullet, that the sources of the differences have very important policy and welfare implications. And so you can think that it could be that if we're talking about an unemployment insurance program or a disability insurance program, that it's just the number of adverse events or their severity is just different across places. So you're more likely to lose your job, you're more likely to experience a work-limiting disability in one location than another, and that's probably primarily because of differences in population and potentially job characteristics. And so if that's happening, then it's essentially the program is being applied in a fairly consistent way, and it's just the adverse events are sort of not uniform across space. However, there's a whole lot of other reasons that that might not just be based on need. They also might be a function of the value of social insurance that is provided by these programs. And so the rules can interact with local characteristics to mean different things in different places, and I'll expand on that in a little bit. And it's also the case that when you provide sort of even dollar amounts or a national formula for benefits, then places that have low cost of living end up being sort of the costs of going onto these programs, or the value of receiving benefits from these programs, is higher than an area where you have a very high cost of living. So if you're living in Melbourne or Sydney, and you have to make do on the disability support pension, that might be very different than if you're living in in a place with very kind of cheap housing. As long as sort of your other costs aren't fully offsetting that. And so you've got these other elements. So in our paper, we try and make this distinction between place-based factors that affect need versus value, and we try and tease that out. So that's kind of that's why we're interested in this. And then why am I personally interested? There's a Social Security Trust Fund that funds the disability insurance system in the US. There's always concerns that the money's going to run out one day. And then once we're in a world of like having to make cuts or having to make difficult choices, things like indexing the benefits to local costs of living and these sort of factors may actually be some of the least harmful, the least harmful and most welfare protecting policies. So I've kind of always thought that this is an area we need to understand more. It's got a lot of interesting academic elements, but also it's something where having a good understanding of the policy potential or the policy implications is quite important too. Okay, so what do? We examine these issues in the context of US Social Security disability insurance. And it's just a very large program. Basically, it's covering anyone with a sort of a meaningful work history. Typically, people who have worked at least 5 of the previous 10 years will be covered by the program, and that in the US is around 175 million people. And it protects workers and their families against the economic risks associated with disabilities that limit their earnings. And these disabilities this is distinct from workers' compensation. These disabilities don't need to be associated with employment. They just need to they need to last more than a year or result in death, and they need to prevent people earning above a level that's known within the system as substantial gainful activity. And that's sort of roughly earning, they can't be earning more than sort of $1,200. They can't have the potential to earn more than $1,200 a month. Okay, so that's the program. It's a very large program. It provides benefits to approximately 10 million individuals, so around 4% of the working age population. It's kind of broadly similar to the disability support payments in Australia in terms of take up, although in the US there's a second program that means that the overall payments to disability to disabled individuals is a bit higher. And so it provided around $150 billion cash in 2019. People don't get access to public health insurance in the US unless they have some other eligibility criteria. And so people who join this program, they get access to quite a good form of public health insurance that's also called Medicare. And that provides, that's sort of valued at around $70 billion. And so when we're talking about what's the overall size of this program, it's kind of representing sort of roughly 10% of all federal government spending. So we're talking about like a huge dollars. This is sort of an interesting feature that is not always appreciated in the US context. Is there's a lot of kind of gaps in the social safety net. But then there are programs like this that are actually kind of relatively generous with kind of quite high take-up rates, and so that's why it sort of accounts for so much spending. Okay, so it's a collaboration, as I said, between me and David and Amanda. We examine and model county level differences in disability insurance application rates and also the number of people who receive eligibility. We do this at the county level, so there's around 3,000 counties across the US, and so that gives us an enormous amount of variation to use. And so we think about place in terms of counties. You know, applications and awards are the key. They determine the overall beneficiary numbers. I'm going to show you a lot of stuff around beneficiary numbers overall, but it's really all happening at the inflow. We determine the key drivers of geographic differences, and then we think about sort of the ex ante and ex post welfare value of disability insurance, where ex ante is before someone is disabled, you know, at birth or at earlier ages, where they don't know whether they're going to need the program or not, but there's an insurance value there for them. And then ex post is obviously conditional on receiving disability benefits. There's a nice thing about the collaboration here is Amanda and David have sort of very good macroeconomic tools. I'm able to bring, you know, a path to getting very good administrative data. And so what we've been able to do is compile a whole lot of information on disability insurance applications made over the 1996 to 2014 period, and then sort of track all those applications in terms of allowance rates, and we're able to have sort of some cuts there by sex and age and so on, and how people are awarded benefits. And then we combine it with as much information as we can that's held at the county level. So we have county information on you know, average earnings, employment to population levels, poverty rates. We have county level information on mortality, housing costs, and which is kind of proxying for local cost of living, and then medical prices. And so we've particularly for a macroeconomic exercise, this is an incredibly sort of rich amount of data with a lot of variation. So why do we need the macroeconomists involved? I hear people thinking. It's a very complex environment. So we've got national benefit and eligibility rules, and we do have some state policies that potentially affect things, but all the action is kind of happening at this very local level, and we need to sort of take account of a lot of things, and the macroeconomic approach, I think, is a very useful way to do that. We use the model explicitly to model all the relationships with the different potential determinants, and essentially the approach is very standard within macroeconomics, where we're kind of bringing in rich data, we're using the model, and then we're matching a certain set of data to determine our key parameters. And what we're able to do here is there's some things that we're matching at the state and national level, but we're able to match you know, local county characteristics, which provides a lot of discipline on the model. Importantly, we have some sort of latent value of health that is unobserved, but is kind of driving both, you know, things like life expectancy, but it's also you know, a very strong determinant of whether someone is going to be disabled, and also whether they're going to decide to apply for disability insurance. And then the model is also very useful for thinking about you know, people's interaction with the local labour market. We compute geographic differences in the welfare, insurance value at birth, those who are in poor health, and as I already said, conditional on DI receipt. This distinction that we're making a big thing of in the paper, which is what are the differences that are a function of need, and what are the differences that are a function of value, and then we're sort of going on to characterize the welfare implications of different policies. Okay, I'll just pause for a moment, and Barbara, are there any questions?
There's nothing in the chat at the moment, so.
Okay, so I've tried to cover, you know, what I see as the key characteristics, but if there's something that it's always a challenge, you know, introducing a program, but you should think about it, you know, a good starting point is, you know, pick your favorite developed country disability program, and it's operating, you know, in broadly similar terms. Okay, so I'm going to just give you a sense of some of the geographic variation. And so 1/3 of working age adults in the US live in counties that account for more than half of the disability beneficiary population. And actually, as you get into the tails of the distribution, then you just see enormous differences. So there's approximately 6 million working age Americans that are living in counties where more than 1 in 10 individuals are receiving disability insurance. And so this is kind of, these are people who, for whom the majority of these people, this is their only source of income, and for about 80 or 90%, it's their primary source of income at the household level. And about 7 million individuals live in counties where fewer than 1 in 50 individuals, working age individuals are receiving disability benefits. So you've got this kind of enormous variation that's coming out of a national program. And just to sort of fix ideas, we can map these beneficiary rates for all the counties, nearly all the counties in the US. We just lose some. The grey is just some data where we have some county boundary issues more than anything. But just to sort of explain this a bit, you're probably drawn primarily. So I assume you can see my cursor as I'm moving around. So if you look at the southeast quadrant, you get this very dark red, and so some of the highest rates of disability beneficiary take up are in states like Kentucky and West Virginia and Virginia, Alabama. And so this kind of Appalachia region, for people who have followed, the U.S. presidential election, the vice president candidate for the Republicans is J.D. Vance, and he wrote a book called Hillbilly Elegy. And he's very much talking about this sort of Appalachia region where there's a lot of poverty, income's very low, and this has been kind of documented as the area with the highest disability insurance rates, and I was reading a paper where they documented that from the outset of the program in the 50s and 60s. You see sort of other pockets here and there, and then in contrast, if you look at the sort of the northeast. There's a lot of population here. We got New York and Delaware and Rhode Island and Massachusetts, like relatively light shading. And so if we kind of highlighted, there's both sort of regional variation, but if we also looked at urban density, we would also see. This also suggests that there's a lot of variation that way, and you can kind of see that at the darkest line, you have up to 20% of a working age population receiving disability insurance. So the number of disability beneficiaries has grown over time. This is absolute numbers, but this is also true if we scale. It gets a little flatter if we scale by population, but it's also the case that the overall rate of disability take-up has increased, over a long period of time. What's interesting, however, is the relative dispersion is actually pretty stable. So I've got a y-axis. So let me just focus on the figure on the left initially. So we have the 25th to 75th to 25th percentile. So all I'm doing here is I'm looking at the 75th, the disability take-up rate at the 75th percentile among counties and relative to the 25th percentile, and I looked at that on an annual basis. And so what does a value of 1.3 mean? It means that the county at the 75th percentile has a take-up rate 30% higher than the counties at the 25th percentile. But you can see over time, everything sort of is lying between about 1.31 and 1.38. So it's actually it's moving a little, but it's broadly stable. If we do something similar on the right for the 90-10 percentiles, firstly you see sort of, as I talked about already, much greater dispersion in the tails. And so this is sort of hovering around 3. So that means a county at the 90th percentile of DI beneficiaries has around 3 times as many beneficiaries, or 200% more beneficiaries than the county at the 10th percentile. But again, even though it looks kind of like some stark differences, if you look at the scale on the left, it's actually pretty similar over time. So we've had this enormous growth in the program, but it's actually been sort of relatively proportionate across these counties. And then just as a first pass of thinking about the determinants of geographic variation, one thing that we can do, and one of the advantages of having the state level at the sub-state variation, is that we can just look at how much does state variation explain what's going on. And so there are a lot of important factors that might affect disability insurance take-up rates at the state level. So the offices that Social Security Administration run, they're actually run at the state level. And so there could be, I mean, there's national policies, but you could imagine there might be sort of local applications of those rules may differ. Unemployment insurance in the US is a state level program. And then low income public health insurance for lower income people, the Medicaid system, that's also a state-based policy. There's going to be sort of other programs as well. What we can do is we can just kind of bundle that all into some sort of fixed effect and say how much could state-based policies explain, recognizing that we're probably including things that aren't purely just related to state policies. And so what we can do is we can look at the amount of within state variation relative to the total variation. So the way to think about this is a value of 0.6 is saying that 60% of the overall cross-county variation is at the sub-state level, and 40% is explained by state boundaries. And you can see kind of all the way through the history of the program, or certainly from where we have these data, which is from 1970, then sort of roughly 3/5 to 2/3 of the variation is accounted for, is occurring at the sub-state level. And so that means a couple of things. One is that state level policies are unlikely to, like we need to do more than simply focus on state level policies. And then the other thing is that it's I think a good justification for our use of very detailed data. And so the fact that there's been some work in this area, a lot of it's done things at the state level. We think we're kind of getting a lot more action by going to a finer level. And you can kind of see that as you focus in on particular states. So here I'm really showing you the state of Virginia, which is really the poster child of this sort of variation. So I'm showing you the most extreme case. But for those who just to give you a little sort of overview of Virginia. So the northern part of Virginia, which is the very light areas, that's right on the edge of the District of Columbia. So you have a lot of government workers. You have the Pentagon. You have some very wealthy counties up in the north of Virginia, and you can see that you have some counties there with as few as less than 1% of the working age population receiving disability benefits. And then you go further south, and you get into poorer and more rural counties, and you get to these kind of numbers of as many as 1 in 5 people receiving disability benefits. So that's just to say that the state variation, state variation is clearly something, but it's not. But the sub-state variation is really important. Okay, and then another way to think about to try and understand the potential determinants is to think sort of carefully about how national policies interact with local wages. And so let me just kind of talk about a couple of elements where this is really salient. So I said at the start that eligibility is based on having a disability that prevents working, earning enough to be to be defined as substantial gainful activity. Now, this is a dollars amount in America. If I understand the DSP, the disability support pension in Australia, I think it's an hours test. You can imagine that either one could be justified, but by having a dollar value in the US, you end up with the number of hours that you need to meet this standard is just very different. So in a high wage county, implicitly, if they're taking into account the features of the local labour market, then they're really saying, is this person able to work at least 15 hours a week at the median wage? In low wage counties, people would actually have to work twice as long in order to meet that substantial gainful activity threshold. Now, in practice, it's hard to say that disability examiners are kind of explicitly using this, but you can see how by having a dollar standard that interacts with local wages, you can potentially have a very different standard in terms of work intensity. It's also the case in the disability support pension in Australia. There's a flat payment. In the US system, it's a function of your past earnings, but it's a progressive formula. And so what I've got in this figure is the formula for earnings in the US. What people do if you apply for disability insurance, they work out your average index monthly earnings. So that's your average earnings over your lifetime. And then they say, okay, for those at very low levels of earnings, we're going to give you 90 cents in each dollar that of average earnings you've had. And then beyond a certain point, that switches to 32 cents for every dollar. And then beyond a higher bend point or kink, then it's only 15 cents in the dollar. And so we make marginal tax rates progressive by having them increase at different thresholds. We make replacement rates progressive by having them decrease at different thresholds. And again, if you think about where the median wage is going to hit, for some counties, it's going to hit near that first threshold where people are maybe getting 80-90% replacement rates, whereas for someone who's in a high wage job or a high wage in a labor market where wages are high, then they're going to get a much lower replacement rate. So these are just some features that we introduce into the model, but are important to think about how while we have national policies, what they mean at a local level can be very different. The other thing that we do and we think about is, okay, let's think about a whole lot of other features of of the local environment or the characteristics of people. As I've already said, we have some data on these things, and we look at the correlation between these and DI beneficiary rates. So on the left-hand side is just looking at county mortality rates, and in the model we look at mortality at around age 40 and age 70, and we look at the likelihood of the trajectory between those two points. But here you see sort of a very strong positive correlation between mortality and disability insurance take-up, which suggests that population health is a very strong correlate. We have a medical price index, so that's how costly is it to seek out medical services. Again, we see a very strong positive correlation. We also look at wage levels. And so when you have lower wages, you have a higher take-up of disability insurance. And that fits with what I talked about before about local policies and particularly low-wage counties, people being more incentivized to apply for disability insurance. And then we can kind of see that directly where we can calculate at the median wage level replacement rates, and you see and you see sort of a positive correlation there. So if someone has a higher replacement rate, then there's higher rates of disability insurance take-up. Okay, so I'm just going to finish with a couple of thoughts, basic description of our modeling, and then in the remaining time, if we have some, I'll just kind of give you a couple of specific details. So we bring data together from a range of different sources, and particularly sort of where we had to work with Social Security Administration to extract the data we wanted and then sort of deal with confidentiality and so on. But we're able to have all the data kind of through and then available to us. We focus on applications and allowances. I think this is kind of broadly true in lots of systems, but if you look at the bold line, medical recovery and disqualification, on average, fewer than 1% of individuals exit disability insurance every year to return to the labour force, and so people are much more likely to move on to the Social Security retirement program, which is just the age pension, or to die. And so you can kind of think about, I've talked about beneficiary numbers, but you should think that this is all being driven by sort of long-term differences in award rates. Okay, and so I was just going to, some of this I've showed you. Actually, Barbara, how much longer do I have?
5 to 10 minutes would be good.
Okay, sounds good. So what I'm going to do is I'm going to sort of give you some specifics here without sort of trying to get into the weeds too much. And so we have information, as I said, from the data. We're able to get individuals' characteristics, information on sort of disability take-up. We have some cuts by age. We're able to look at information on income. We've got local place-based characteristics around prices, the allowance process, which we kind of model at the state level because of the state offices, and then we have some other factors, some of which I've already shown you, and so what we're really our main innovation is some of our model is standard in terms of how to think about how people apply for disability insurance, but we're allowing both the incidence and the value of disability insurance to vary by place. Within the model, people have a choice about, individuals have a choice about whether to apply for disability, and then they have a related choice about whether to work or not. And you should think that we have, a pretty standard setup where we have our state variables that sort of give us a time path, and then people have individuals at different counties have these choices. We have a common. I won't get into the details on the utility function, except to say that we use a general utility function. So so we're not saying someone who lives in a particular place values things differently from someone else. We're allowing preferences to sort of be common across individuals, and we have a fixed cost of working and applying, and what we're doing, I'll just again ignore, we're doing everything in terms of working out willingness to pay, and we if you focus on the color text down the bottom, we've got this. We're working out how much of the value in the program is coming from changes in real consumption. So differences in real consumption. So two individuals who have similar disability characteristics, but end up doing differently in terms of the value of the program. and then also contrasting that with need. So, you know, how sort of local population measures, population health measures, sort of represent you know, people's underlying health, and also their how that affects their employment opportunities. So we calibrate the model, and actually this is a nice, this I think is a nice way to suggest what we observe and don't observe. So we have information from another source on medical prices, and then we have housing prices. We have to model the disability determination process, and we have to model how much people, you know, how much money people are going to have when they're not employed. So with how people get by when they're not employed, that's not something we easily observe, and certainly easily observe at the county level. For the disability determination process, we don't easily observe that, but we know that it's operating at the state level. So we're able to have a state level process that is potentially explaining some things, but again, it's an element that we're not able to observe directly. We observe information on age and income. We know the distribution of mortality, which we're using to proxy for disability, because unfortunately, we don't have good detailed information on disability rates at a local level, separate to the program itself. And then we don't observe individual disabilities of applicants, so we have to model that as well. And so this is kind of showing there's some elements where we have really detailed data, but there's elements where we have to use the model to fill things in. We're sort of targeting shares of population who claim, and we do this. You know, my co-authors are sort of running this model to fit a whole bunch of the data. It's ultimately, particularly for macroeconomic model, something that's very rich. One of the tests of whether we've done a good job of explaining things is to sort of model everything we can and then just look at the unexplained component. And so here is just the residuals, the unexplained component that we plot out based on, you know, and so this loads onto the value of the non-disability option, which is explaining the y-axis. But if you just look at the variation, so this is essentially, you think about the x-axis as variation in mortality rates. If there was something that we're majorly missing, then what we would see is a very kind of defined, you know, we could see some sort of defined relationship where we're missing something about population health. This is just a way of sort of suggesting that we're actually doing a pretty good job of having most of the population health elements in there. We do this for a range of other outcomes as well. But this wasn't necessarily familiar to me as a diagnostic, and it may not be familiar to you either. So I think it's just useful to point it out. All I'd say, I'll stop here, Barbara, or sort of jump to a conclusion slide. What we can do is we can work out the willingness to pay for disability, and so across the US, the median value, people are willing to give up sort of close to 10% of future consumption in order to have the disability insurance program. Now, at first pass, that might sound quite high, but I'll remind you that we're talking about a program that provides benefits to 4% of the working age population, that provides very generous benefits. And then in a world with uncertainty, we also value that strongly. You can see that the willingness to pay and the value does kind of broadly map to where the highest disability insurance rates rates are, although there's a little bit of variation loss. This is just using everything at the state level, and unsurprisingly, we see that disability applications are highest where welfare gains are the largest. It's also the case, however, that the allowance rates per application are lower than where welfare gains are the largest. And so the way to think about that is that ultimately the people who are on the program are more likely to be in an area where the welfare gains are the largest. But it's also the case that the marginal applicant is less likely to receive benefits in those locations. So some of some of the incentives to apply don't necessarily result in award of benefits once the disability determination process is done. Okay, so we have a structural model. We're trying to get at the disability. Our bottom line is that we find sort of this both kind of really high welfare values and then just enormous variation in those welfare values. And we're at the point where we're fairly comfortable with the model and where it's at, and we're now thinking of sort of rounding out the paper in terms of some thinking more about these policy applications. But we're hoping that this is for the first of for us, hopefully kind of 2 or 3 papers in this area where we're getting some information on processing times from Social Security. We're getting some information on the mortality of beneficiaries, where we can model health in a more explicit way. And so so that's kind of where this sort of paper sits at the moment.
Thank you very much, Tim. It's very fascinating to see this enormous range of variation and how important the program really is. We have a few questions in the chat, and 2 of them are from Janine. So maybe instead of me reading them out, Janine, do you want to just elaborate on that yourself?
Thanks, Tim. That was great. I'm just wondering what you know about the type of disability, or can you infer that? Sorry if I missed it. Can you infer that from the amount of social insurance that's paid? And I was also thinking about work that Deb Cobb-Clark did here in Australia about intergenerational welfare receipt and how, well, I think she found with Sarah Darman, who's here on the call too, that once you move on to disability, you stay on it for a long period of time compared to other kinds of payments, and also that there's this intergenerational welfare inheritance. So if your parents have been on social insurance, you're more likely to be on social insurance as a child, as children when they grow up. And so I'm just wondering if you know anything about household types and whether that kind of goes into the model. Who are the people? Are they single? Are they what kind of households are they in?
Yeah, so I think we're using demographic characteristics by sex and age. I don't think we're using things like marriage rates and so on. We can possibly I'll need to check that, and we can probably we can incorporate that. That is able to be incorporated at the county level. Now, in terms of types of disability, we're not doing anything with that. So we were able to. One of our challenges was, in order to get the data, we had to pass disclosure rules, and so we always need at least 10 observations for any outcome, and so there was a real trade-off there. And splitting into sort of groups like mental disorders and musculoskeletal conditions and so on, we would have just lost a whole lot of counties. Now within the mortality, we have the potential to look at different causes of death which that works that doesn't work terribly well necessarily for something like mental disorders. But no, we've kind of abstracted from that. We've abstracted from, we don't have a time dimension in the model, so we're not using temporal variation. The dispersion that we're interested in is pretty persistent, and then intergenerational insurance, intergenerational characteristics. You should think that in our model that's getting kind of loaded onto place. So yeah, I mean, there's been a lot of good work in recent years looking at intergenerational characteristics and showing that the receipt of one household member or one generation affects subsequent generations. But that's ultimately, typically a very complicated data exercise, and what we've had to do is from a data point of view, the level we're operating at is not necessarily the ideal in terms of unpacking detailed data, but we think sort of to get at place we're able to make those compromises. But I think you make a lot of good points. The very actionable one, if we haven't done it already, is to think about incorporating more demographic information. Yeah.
Thank you.
Thanks.
Can I just jump in with a question of my own? Do you think, broadly speaking, this is a good idea to have a policy defined at the national level, or because at least they funnel a lot of money into the poorest areas? Or do you think it would be better to have a more flexible?
Yeah. Well, firstly, Barbara, you know that I never answer normative questions. I only ever describe the state of the world. I do think I think there's a bit of a trade-off here. So you obviously want sort of a pooling of risk across space, and so having a national program is very helpful. I think when it comes to I think it is hard to, if we're living in a world of like utilitarian welfare, social welfare functions, then it's hard to, like, you want people to be protected in broadly similar ways. And so I personally think that, if you have to find if you have to sort of find cuts or you have to make rearrangements, then you can probably, by sort of taking account of local features, you could probably design the program better. Now, the political reality is, the moment that you're talking about, like our political systems are nearly always organized along geographic lines. And so in Australia or the US, what you would be doing in any sort of policy innovation in this space would be sort of telling a member of parliament or someone in the Congress that that their constituents are going to get less out of this program than other people. Now, a lot of those constituents in those cases, they probably paid less. They almost certainly paid less into the system because at least in the US system, you have Social Security taxes that are a function of earnings. But I think this is like this is an area where this is actually really interesting to think about, and we could I think improve program design. But I think also I recognize the political reality of geographic-based reforms is probably actually really hard.
Yeah. Thank you. Sorry for asking a normative question in the first place.
That's all right. I mean, we all have our opinions, but you do, I think this is true of Australia as well. Like you kind of, on one level, you design a program, but you have such a kind of diverse country that it's very hard to sort of, this is true of almost any sort of element of government. It's very hard to set rules that that sort of have broadly similar effects across the country.
Yeah. Okay. There was another question by Chandana about the relationship between take-up rates and natural disasters. Do you want to say something about that, Chandana?
Sorry.
Or directly?
Yeah.
Okay, so the question is if there's take-up rates in areas with higher risks of natural disasters, if they are higher there.
I think, I mean, there's been some work, I've seen some work looking at, I mean, tornadoes in the US is kind of it's been a tool in recent years to look at, you know, charitable donations and take up and so on. I haven't seen the effects of natural disasters on disability insurance take up, but there's a whole lot of you know, there's a whole lot of studies that have shown like a broad range of determinants. So I wouldn't be surprised if natural disasters play some role. One of the challenges with things like natural disasters, this is also true of recessions and so on, is that this is a program where sometimes people are more likely to apply because of a temporary shock, but then it's a permanent program, whether intended or not. You know, if someone goes in, they never come out. And so to the extent that this is playing a role in natural disasters, it's probably not a good thing in terms of policy.
Hello, team. Yeah, thank you very much for the very interesting and motivating talk. Let me bit about myself. I don't do anything about disability insurance, but I am doing something about private health insurance in Australia. Yeah, so as you may know that private health insurance policy in Australia is nationwide. But having said that, we do observe a lot of that variation by location in the uptake of the private health insurance.
Yeah.
Some of the factors that you also explained include in the model of that. Now some of a lot of things are happening, and that might affect why this location have a higher uptake than the other. So I do share with that. And actually, I did came across one of the paper published recently in the journal of I think the political economy about whether the disability insurance plays that, and I actually found it did. So it's very motivating. So I'm thinking whether I can do something about it using Australian data. So thank you for that. So that's good to see you in person today. And one of the observations now, they are the one with I think one person raised it already. And what we did find in our recent study, now we find out that some of the factors that got location, that got local factors like natural disaster that we use now cyclone. Now when the cyclone strikes some areas, but not every other area, so we did observe that affected individuals can increase uptake of the private health insurance in Australia as well. So I think, yeah, you are right that there are some kind of the confounding factors associated with the local kind of natural disasters, but somehow if we can include that in the model, and I did come across some of the US study. They look, but they are maybe the result may not correlate yet, but they look at some correlation between the natural disaster with the uptake of health insurance, not disability. Yeah, so, but that's something that I came across. So I thank you again for the very interesting and motivating talk. So that's my
okay. Thanks. I mean, I would say, I mean, there's a real interest in understanding place, and so I suppose, you know, if you take the US situation, and this might be somewhat true in Australia as well, there's lots of recognition that if we look at different measures of well-being, then some areas are doing better than other areas, and so there is this sort of strong interest in understanding the role of place, and then how both how it determines outcomes and then what can be done about it. And so we're we have our own contribution here, but I think if you're interested in this area, it's something where lots of people are very interested.